Hello, guys. Just wanted to join today's Macro Mondays to talk about the Phillips curve and why it matters and why it's dead. And I don't know if you guys were fans of the Saturday Night Live show, but back in the day, Eddie Murphy had a fantastic skit. Buckwheat was dead. Breaking news: buckwheat is dead. So that's what came to mind. The Phillips curve is dead. So just some reason I thought of that in conjunction. This has nothing to do with whatsoever or anything, but just found it to be hilarious. So first and foremost, the what. What is the Phillips curve? And this is Investopedia's definition, and it's basically just saying that the Phillips curve is the changes in unemployment being a one-to-one relationship inversely. So the higher unemployment, you can expect inflation to be lower. So the theory is, conversely, if you have really low unemployment, then inflation should be high. Is essentially what the relationship is starting out with. And so that begs a question. And well, why is it a relevant conversation today? And this is from the Fed chair's press conference in just the very latest result. And this is a quote: "Despite the slowdown in growth, the labor market remains extremely tight, with unemployment near a 50-year low. Job vacancies still very high and wage growth elevated. Job gains have been robust and employment rising by an average of 272,000 jobs per month over the last 3 months. Although job vacancies have moved below their highs and the pace of job gains has slowed from earlier this year, this is the big piece. The labor market continues to be out of balance, with demand substantially exceeding supply of available workers. The labor participation rate is little changed since the beginning of the year. The FOMC participants expect supply and demand conditions to be in the labor market to come into better balance over time." And this is a really important piece of the puzzle: easing pressures, the upward pressure from wages and prices. So right here, the Fed is saying, all right, we really think this is a problem in the economy, and this is one of the sources that we're really concerned about. So this starts the immediate question of, well, oh yeah, we have that relationship between unemployment and inflation. So therefore, let's look to create some unemployment to ease the inflation. But unfortunately, that may not be super successful. Let's take a look at this. This is the Consumer Price Index, less food and energy. And what I really want to stress here, which is really fascinating, look at how it yo-yoed much more significantly pre-1980. And then look at how much more stable it's been ever since, up until 2020, pandemic and COVID, and now the war in Ukraine. So very, very, very stable overall since the 1980s, and it's been a lot more lower on average. And so that's an interesting fact in our discussion for today. And we turn now to how can the Fed leverage the Phillips curve and to curb inflation? And that's the question that's like, okay, well, what are we doing with it? How can we leverage that? Well, this is a fantastic paper written by, let's see, let me move this. This is can't remember who wrote it. It was David and Sim wrote a Fed working paper, "Who Killed the Phillips Curve? A Murder Mystery." And so this is one of their workhorse models. They're saying that that's been one of the things that they've relied upon over time to be a model for inflation. But what they were doing is they said, well, wait a minute, this doesn't feel like it's been the same since 2008. And then that was indeed their finding. Since 2008, they're like, and the main takeaway was back from the GFC, we saw of course, we had a big spike in unemployment during GFC, and then then eventually the things to reignite things and start to recover. And the interesting thing is, over the last decade, we haven't seen inflation spike up until COVID. So that relationship between unemployment before COVID was really, really low. So what they're saying is, well, wait a minute, what's going on here? Why isn't this? They're not working together anymore. Why is that the case? And so a number of different people in the paper, and this is a great paper, and I'll have it available if you really want to read the full in the weeds. I think George might want to look at even the full paper to see the data and which they do, which is George's thing. He's really excellent at getting really down deep into the weeds behind the mechanics of their models. And I recommend everyone follow George, by the way, and his YouTube channel is really stellar in terms of market analysis and really getting some granular data. Well, wait a minute. Maybe he should be the data science of real estate guy. Maybe that's what he should be. That's maybe a brand we should suggest for George. No, but seriously, George's data science and PhD in biology really shows in his work, and it's an incredible channel for everyone to check out. But returning back to the what we're looking at here and what we're trying to understand is like, well, wait a minute, what's going on? And so we turn to the answer to the question was interesting. They did a survey of bargaining power, and the answer of why the Phillips curve is dead is based on the data science. Is they're like, well, wait a minute, bargaining power is no longer available. They said back here, basically, and I remember this, the airline strike back in the 80s, early 80s, Reagan fired a bunch of air traffic controllers. And that was like, there was definitely well, I don't know if anti-union is the right thing, but there was a lot of movement in that unions were really, they started to wane. And I would say the power of unions in the past couple decades really has waned in that. So that correlates almost directly why the Phillips curve, according to this paper, and it's really, I mean, if you look at the data, it looks like a pretty reasonable answer. And again, guys, I don't have a dog in this fight. I'm still open to other interpretations for sure, but I think the paper presented a pretty compelling argument of why the Phillips curve is dead and why the Fed may be wanting to use this lever. And okay, we want to create some unemployment to cool the economy off, but in fact that the only way that this would happen based on this model, and if you accept that this paper is correct, the only way for the Fed to be able to exert influence again was to have more influence in labor force in terms of wage price. And that's a real good question. Are workers getting some of that back now? And that might lead to, and again, I don't know if it's going to be enough soon enough. Are the workers getting enough influence over wage compensation to make the Phillips curve start to work again a little bit? And that was my question after looking at this data for a little while. I'm like, well, wait a minute, would that be the case? Is it going to be a situation where labor has enough pricing power now again that might start to come into play? And based on the what this paper presented, I don't think that that's going to be soon enough, fast enough, if that's their goal. But that's my interpretation of things. And that was my 50,000 foot overview. Definitely, guys, if you have questions, I'm happy to entertain them now. And to the extent that I have an answer for it, I'll definitely try to take a swing at it.
Do you think there's going to be some kind of lagging indicator between kind of unemployment, kind of tracking back to inflation? Is there maybe some level of lag there?
I think there's definitely I think that's already happening. You see data anecdotally of layoffs happening. It will definitely kick in here. And again, the extent that it does, and I think is a real interesting question. And I think that's BD. I think one of the intellectually interesting things about what the Fed tries to do is they're trying to, skate to where the puck is. There's that old Wade Gretzky quote. I don't skate to where the puck is. I skate to where the puck is going to be. And so this is an exact problem that they face. That okay, is what we're doing actually working? So there's that lag between input and getting the corresponding feedback that they're trying to get. But I do believe that if you look at the anecdotes of headlines and whatnot, it may not be showing any measurable data that we have formally, but we're definitely seeing anecdotal evidence to that exact same thing.
Yeah, it'll be nice if this chart kind of continues on to 21 and 22, right? Because
Yeah.
there's a lot more data has come in since. It'll be kind of see which way directionally it'll go, from a quantitative scale.
I think so, and I think that anecdotally, again, if we agree or accept the assertion of this model and this paper, that basically that bargaining power probably is not going to come back to any substantial amount. I tend to think that that's probably right. Although the flip side is there was that stuff about, we saw the quiet quitting stuff and people having more influence over their wages and whatnot. But I think a lot of that's almost already probably back out of the market because, hey, we're looking at a recession already again. So I think that any power that labor might have had to kind of combat this particular component might have gone away already. I don't know, but I'm definitely open to thoughts on that as well. All right. Anybody have any questions or observations about anything about that, or generally any other economics topics that they'd like to talk about?
Well, I was just thinking that the Fed skating toward the puck, there's a lot of criticism of the Fed that actually is they're very reactionary and don't skate to the puck at all. I'm not a macroeconomic major. I read and listen to a lot of this stuff because I enjoy it, but other sources that I have are saying, the market is telling that bad news is on the way from everything from, container pricing and inventories and euro dollar inverted curves and all this other crap. So it could be just another example of possibly the Fed doesn't actually know what they're doing, in the sense that they're trying to fit humans into models, and that's very difficult to do.
Yeah, and they did say, not this last Fed conference, but the one before, he explicitly said we would much rather overshoot on the over aggressive side and then react. So what their fear is not being aggressive enough on inflation. So I think what we're seeing, and I think you're right, I think, and Greg, that's excellent that you mentioned container data. We looked at the port data last week from LA. It's down like 23% in October. And it's like 20% in Long Beach. So it's like really significant drops in West Coast traffic anyway, for sure. So there's a lot of data to suggest that a lot of the things that they're trying to combat are already really aggressively changing. Except, and I think this is the one piece, and that's why I think the Phillips curve is an interesting discussion. Unemployment really so far that I've seen really reacted much to anything they've done. And maybe that's where we're starting to see the flashing signs of that turning red as well.
Yeah, I mean, I think especially for things like retail, we just got to get through the fourth quarter and see how bad or good it was. And then there'll be all kinds of adjustments being made.
I think that's right.
Yeah, I don't know.
I mean, I probably have a very skewed view of things when it comes to the job market here, but I'll tell you, in Silicon Valley, we're very tech influenced, right? So when you start seeing layoffs in tech, it feels like, oh my God, everybody's laying off. But probably just contained in the tech sector, definitely significant number of layoffs. Now, you can go counter argument, well, since COVID until now, there's been a lot of hiring, and now they're kind of correcting. But the interesting thing is we've seen layoffs from companies that you've never seen them lay off people before. Like nobody ever thought Google would lay off anybody. Everybody thought, oh, Google, that's secure.
Google laid somebody off? Uh-oh.
Exactly. And
right.
yeah, no, I mean, Facebook, everybody's like, what? Facebook? It's just very unheard of. So we've seen quite a bit, and definitely I'll tell you kind of what I'm seeing here in terms of the job market is a lot of startups that kind of got some level of seed or some series funding is kind of running out of cash and is not getting any further funding. So there's a lot of either fire sale or liquidation or asset sale. So we're seeing a lot of that stuff, especially around AI. Again, very skewed view of the market here. It's extremely, like I said, push to technology, but definitely I'm seeing things starting to get shakier on the technology side.
BD, I'm wondering, and it seemed like, and this is just my impression, I don't do much with VC or have a whole lot of input or not really in that space, but it sure felt like then during the late in the bubble, like 17, 18, 19, you put we're the Uber of XYZ company and you get funded and go to town. And so literally there were all kinds of really maybe even some silly things getting funded that we're just basically seeing the flip side of that, and the bubble basically is popped in the valley for that reason.
So that dilemma is
Yeah.
Valley exclusive either. A lot of individuals in the finance industry who were the top performers and top earners through 2020 and 2021 are being laid off as well. Especially coming out of investment banks and mergers and acquisition, they're dropping supplies. You can't just take a company and IPO it at $1 billion when it hasn't produced anything and expect it to go okay. They've poured billions, if not trillions of dollars into these SPAC IPOs, and these companies are now worthless at this point. And there's no one going public at this point anymore either. That at least will, in volume, that was going on during that time period. It was another tech situation. Every company, if you went and breathed at a VC firm, they were going to give you $100 million to $1 billion without even asking questions.
Yeah.
All you had to do was get your paperwork in order and you got written a nice fat check. But now they won't even look at you.
Yeah. So there's definitely a lot of that and a lot of what Doug said. A lot of companies did not fully, or maybe VCs are getting to fruition that is a lot of these companies they throw money at are not likely to come back. But that's kind of what the VC mentality is. Like, hey, if 1 out of the 10 make it and make it big, that should pay for the 9 that never make it. But that being said, when I looked at, and I was trying to pull out that chart here, and maybe I'll send it once I find the link, I'll send it to you to share with everybody. But it was kind of looking at VC dollars year over year, and then the breakdown where these dollars are going in terms of geographies. And literally, like Silicon Valley used to be about like 60%. And it's been trending downwards year over year. I believe the last curve I saw it was like down to even 24%. So it means 24% of VC dollars globally is going to Silicon Valley, where it used to be in the 50-60% range a while back.
Oh, wow. That's an interesting number too, isn't it?
Right. Because they're really finding better ROI on VC investing in other geos. And other geos outside Silicon Valley, California, so nationally as well as internationally. Some of the more interesting ones have been kind of like, some Europeans, India, several in Asia and so forth. And a lot of these VCs are going global in some sense. But just from a big picture perspective, I mean, I'm not a huge fan of VCs. I've kind of been in that realm, not as a VC, but on the receiving end of the money. And it's a little bit of a game in the sense that they put money in a company and they just push so much money through advertisement to show, hey, look, there's market traction. Never matter that the revenue, the $1 revenue that came in took about 30 cents worth of advertising to actually generate. But it's mostly to prove to their initial investors, hey, look, there's market traction. The company that we invested, $10 million in at a $100 million valuation right now is worth $500 million. So we need to raise the next fund, and just to kind of show the track record. And
BD, if I'm hearing you right, customer acquisition cost matters again. What? Stop the madness.
Exactly. That's why companies in the advertising world, specifically here, Facebook and Google, are hurting because the amount of spend these startups were doing by direction from their VCs that invested in them has slowed down. So right now it's really about, hey, who can have a viable business model that allows them to scale? It's no longer, drop X amount of dollars and let's see how you can get market traction to your MVP, the market validated product and so forth. So yeah, things are changing in a big way. But you're right. There's always a trend in VC in terms of investment, and I don't want to turn this into a VC discussion, but the fact that you mentioned it is exactly what you said, Doug. There's always a trend. Like I remember back in the 2000, it was like a .com trend, right? And then it went into another. Then it became like a social media search engine kind of trend, and then for a while it became kind of like the Uber and the Airbnb and that whole, I'm gonna say, digitization and taking businesses on the web. A while back in, I would say 15 onwards was all about AI, anything AI. And literally, I think it was 2 weeks ago, there was a fire sale in a big Bay Area here, startup. They've raised over $400 million with a valuation of almost $2 billion, and they pretty much had a fire sale, or I'm going to call it asset sale right now, at 120 million. Yeah, so it's definitely it's like a big game in some sense, but yeah, the economics are shifting right now, and it has become a lot harder for VCs to raise more money, just like it's becoming a lot harder for real estate.
And BD, since you've left that space in startups, you've invested exclusively in venture capital, right?
Since I've left tech, I've invested exclusively in real estate.
Oh, you have? Interesting. No, I'm completely kidding, guys. I think BD's done some incredible work with retail reposition on TripleNet and some other great things, and it's been interesting to learn about BD's fund and how he's operating. So that's why I was being, it's the whole thing. If you're a lawyer, you always know the answer to the question before you ask it. And I just thought that'd be kind of interesting to juxtapose those two against each other there.
Yeah, no, indeed, shifted into real assets.
Absolutely.
Absolutely. And now definitely strong focus on cash flow.
That's interesting. So the cash flow. So cash flow is really important to you these days.
Yeah, I think for the next 2 years, there's definitely more focus on cash flow. I would say in 2018, 2019, investing in a real estate deal that's very back-end loaded. Let's call it low IRR, good ARR, but low IRR because it's extremely back-end loaded. Was probably okay. Now we're definitely looking for at least having 30% of the return come from the cash flows. So, because we only want to take a bet on that 70%. We don't want to take a bet on 90% or 95% of the return.
And Greg, I'd love to get your take on this. Absolutely, BD as well. Have sellers capitulated yet, or are they still being stubborn?
Nobody's taken my offers, but yeah, I've seen some softening on expectations. I know brokers that I'm talking to are having to have more conversations with potential sellers about price expectations. And then the flip side of that is, like you mentioned, it's harder to raise capital, and you're having to raise more capital in a time when it's harder to raise capital. So, you kind of get that double whammy. So I think, we're the past 10 years is what was weird. This is more, maybe regression back towards the mean of what a more balanced market looks like. And, 6-7% historically, it was never the end of the world.
Right. I think that's interesting. And what I've kind of come to believe, especially about Phoenix, I think this was really bad. apologies to anybody who's in Phoenix right now. A ton of, and again, this is not a very nice thing to say maybe, but I love Bigger Pockets, and I don't want to send the wrong message. I really admire the work they did, but I feel like we printed a bunch of syndicators, and maybe, and it was, an abundance. It was like an easy business model to execute in the last cycle. And I think right now we're just going to hit the wall a little bit, and there's going to be a lot of pain in the next year because we had too much liquidity, too many dollars chasing the same deals. And let's follow this all the way out. Bridge, and here's the real question of the day. I'm fascinated to hear if anybody has any take on this. Do bridge lenders extend and pretend from debt they originated in 19 and 20? Or do they say, well, I'm sorry, we're just gonna, give us the keys. I'm sorry, you have to go. Does anybody have any feel for that right now?
My guess would be that they would extend and pretend because they're largely lenders, not operators. I think there'll be some pain, but I still also think the market will save a lot of people, and it won't be a function of people going bust. It'll be a function of people not getting the returns they promised, and we'll be able to get out with some kind of upside, but maybe not. And I shouldn't say promised, but not what they projected. And so, I think most people will be fine, but it won't be the unicorns and rainbows that everybody hopes for.
Yeah, maybe three more equity multiples in 2 years.
Yeah, well, and honestly, I think those things were in the minority anyway. That's just, nobody is on social media celebrating their completely, average wins. Don't get a lot of interaction by saying, hey, I did what the market did. So, there's all that survivorship bias. So
for sure. And for the guys that don't know Greg, if you ever need to know from a real operator, somebody who just really excels at the asset management side, highly recommend getting to know Greg for the record.
Thanks, Douglas.
Absolutely, for sure.
Greg's great. I'll second that.
Awesome. And Greg, I think it's also true too. I think what's interesting about that, the aspect of what they did in 2008, and I don't even know if this is necessarily a regulatory thing that happened, but banks not being as much in the business of the short-term bridge debt as much. And it's more like these are other syndications basically that syndicated the debt that have this bridge stuff that's sitting out there that might be a little distressed right now. It's not a bank, so they don't have a regulator saying you have to get rid of this. And so I think that's an interesting component of the distress in the market right now. Generally, and again, I don't have a lot of data yet. This is like a rabbit hole I'm trying to go down right now. I'm trying to get a little bit better data to support my overall thesis. But it seems like right now the distress is going to be a little bit different. And especially if you believe in the theory that things are that because the interest rate was so high so fast, that it's going to have to come down fairly quickly as a response, because things are going to hit the wall pretty fast. And so that may be how it goes. Now, George had some interesting data in his last presentation. I think it was last Monday, wasn't it, George? Where most declines from interest rates are fairly gradual. So that was really helpful to kind of have that in mind in terms of how gradual the rate cuts will be. So and again, I have no idea where that's going to come down. I think that's a really fascinating question.
Well, I still have Fed funds rate being above 4% through the end of 24 and even into 25. So your mortgage rates are going to be up at 6, 7, 8. Hard money is going to be at 12 to 15. Ethan's going to be at wherever he's at
9,000.
Somewhere on that scale. 100% for 3 months, nothing
That's
less.
right.
You don't call him the LIFO king for nothing.
That's right. He is the LIFO king.
Yes, he is. As far as policy goes, Douglas, the thing that's going to be interesting this time is instead of the banks doing, like synthetic CDOs internally, rather this time around they've just lent it out on overnight repos for it then to go be leveraged out into the market by other institutions. So it's not the bank that's doing it. They just added, their friend Joe to do it for
Right.
like tell me here's what I don't so I have seen several brokers over my time of trading. So futures contracts are leveraged internally 30, well, at least the NASDAQ ones that I trade are internally leveraged 35 times to 1. And then I also get 20 to 1 ratio on dollar per point. So you can do the math there. And then I found platforms that will allow me to leverage up 100 to 500 times from that. So how are you going to let me leverage, 4,000 to 5,000 times to 1 and maintain safe risk management and asset protection for your brokerage firm? Because like if I launch 1,000 NASDAQ contracts and it goes against me and I lose $10 million in a day, you're not going to get that from me. I'll just declare bankruptcy and you're going to have to write off that loss. Now, what happens if that happens multiple times or on the institutional level? The problem is their risk parameters, just like in 08, they aren't calculated for this type of stuff. So,
Well, we have the history of just bailing you out. So
You'll be fine.
you'll be fine. There'll be
honestly,
a few people that have to take the brunt of it, but the mass majority that'll be in the same position of you will be picked up by the taxpayers.
I hate to be a part of the problem, but the day that opportunity presents itself for me to go and do whatever the fuck I want in open market operations with zero risk, I'm doing it. And I don't care what anyone says.
Yeah.
Yeah.
I think anyone would, no matter what they say today. Zero risk, you go bankrupt, we'll bail you out. Absolutely. All in.
Heads I win, tails you lose.
Exactly. Like I'll even you can even tell me what you want me to buy. I'll do it. As long as I get my own little allocation to go and play.
Well, and I really can't thank you enough, Dylan, for bringing the Wall Street type of component to this. That's the area I'm really, really fascinated to learn more from you on that. I think that having the macro thing is one thing, but seeing the financial sector component of it, I think is still really mystifies policymakers. I think they just don't get it. And I'm interested to see what we can learn from that aspect of it.
Well, I mean, like debt and loans can be anywhere from hours to centuries. So the Fed has repos and reverse repos. Now that's traditionally done between banks. But if I have a banking division called JP Morgan Chase, and then I have JP Morgan Investments, and I can just overnight lend my investment firm or investment division, whatever, on an overnight basis at 0.03% to give them extra leverage and liquidity to go play in the Asia markets at 2:00 in the morning, then sure, I'm going to do it. And it creates this cycle effect where everything's so leveraged up, and it, when we're talking someone like JP Morgan's investment division, I mean, you're talking billions, actually you're more talking trillions of dollars being injected. And the only things that can handle trillions of dollars are the S&P somewhat and bonds. That's it. So you put that money and start allocating chunks of it elsewhere, it's going to inflate it. And since the S&P is based on the top 500 companies, you just inject it straight into those companies opposed to ETF, and then all of a sudden you've got the ETF to rise. And you don't even have to do it over 500. You do it over their top 20 to 30 holdings that are heavily weighted. All of a sudden you've spent 25% of your money to drag the index up the same amount that would have taken double your allocation if you just did it directly. And that causes problems, especially when you don't account for volatility indexes like we've seen over the last year, and price valuations fall back further than you had adjusted for on your risk reward basis, and then you're starting to get margin called and you have to liquidate, blah 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 blah. And then they're even taking this money and going and buying options contracts with it in future, which makes it even worse. Which is what Chris and I are doing, just on a smaller level and not as bad.
Right.
Not as destructive.
Oh, I think Chris is very destructive. No, I'm completely teasing. Chris Perkins is the man. I'm just completely kidding. What I will question you, Dylan, on this particular component, would love to know, petrodollar versus petro yuan. Where are we at with that? And is this a discussion for another day, which I think it might be, because I don't know enough about it to question, is that a real threat to us economically, or how are we looking on that aspect of things?
It depends on how you look at it and how we respond. I mean, there's too many variables that go into that question, but like, we have all of China's debt holdings in Africa that if they go under, they'll control. But at the same time, if we just want to shut China down, all it takes is a couple warships to go sit outside Malaysia and a couple UAV drones to drop bombs on their pipeline sitting in Kyrgyzstan. And all of a sudden, China has no more energy production and they're on a 30-day clock. And I mean, even if they do respond to a threat like that, it's not going to be over in 30 days. So right now they're winning. Granted, we have a sitting president who doesn't know what time it is or when to go to the bathroom. But once that crisis is resolved, I think we might be in a little better shape to negotiate and fight back. It's so dependent on many factors, though. The U.S. can self-sustain its own energy. We don't need energy from other countries if we don't want it.
Especially if you vote for me, because I'm bringing back nuclear power plants for everyone. George, you get a nuclear power plant. Greg, you get a nuclear power plant. Dee, you get a nuclear power plant.
You'd be the Oprah of nuclear power
I am the
plants.
Oprah Winfrey of nuclear power plants. That's my plan.
Well, what will be interesting in the energy sector, I'm not sure if it'll happen in everyone's here's lifetime. It may not even happen in my lifetime. But as the northern seas melt, how that affects energy trade, because you can now go through the top of the globe opposed to around it.
Oh man, that's an interesting thing. We'll have to see how that transpires too. So it's
Speaking of end runs, China's also working very hard to make sure that they're not constrained to the Straits of Malacca anymore. And they're building a lot of overland pipelines. So It's certainly the case now that naval power can shut them down very easily, but may not be the case in the future.
Well, even so, that's where the drones come into play. I mean, because I believe the last thing I had read on the issue is they have deals with Kazakhstan, Kyrgyzstan, Tajikistan, Uzbekistan, and Turkmenistan. All the Afghanistans to go through their land, and in return they provide military and financial support to them. But I would rather bet that their deals that they have in the Middle East or Western Asia are the same to that of the deal in Africa.
No, thank you.
But we'll see. I mean, it's a pipeline. It's pretty vulnerable. So we'll see. And they sit above ground too. I mean, when you have thousands of miles of pipeline, it's not exactly hard for a stealth drone to pick a spot. But China is so dependent on energy from foreign nations, even if you just choke off one of them, it's going to cause a wrinkle.
Well, I'm more a little bit concerned just with the recent situation where Saudi Arabia signed a contract to sell China oil in their yuan.
Yep.
And what implication that has at a macro level to the stability of the US dollars, because significant part of the stability of the US dollars against other currency has been, it's the major currency that oil is being traded in. But as more and more countries, especially a big consumer like China, start to take oil in yuans, where does that leave us? Are we going to start seeing more volatility in the stability of our currency? As it start to get replaced as a major currency?
I think that's a stellar question, BD, and I don't know the answer to that. I feel like what we're going to see is some sort of duopoly instead of a monopoly, maybe. I don't know that we can avoid a significant like a two-part system where both currencies operate, because I feel like China's in a position that they're the bully consumer in the room. I think as you look at the long run growth of what their economy is going to do with energy, I think they're going to kind of force the issue a little bit. And I don't know that there's much we can do to stop it, but I don't think the US dollar will become irrelevant either, though. I don't know that it's going to be that, but I think these are fascinating questions, and I am definitely not the person to ask, but I think these kind of questions are some of the things that we will continue to pursue along the way of our journey on Macro Mondays, or whenever we do this lecture and discussion group in the coming year. But for sure, this discussion I feel like is one of the big under the radar issues that we might want to keep an eye on, just to see how that's going to play out.
I think if China ever poses a threat with the yuan, a lot of our business relations over there probably go away, which means onshoring of every product that we've offshored over the last several decades. And if the quote unquote, well, actually it's not even quote unquote, they are the economic producer of the world, loses the largest economy, which is America at this point, I mean, that pretty much shuts them down. So they're only on top because we allow them to be, in my opinion.
Oh, and Greg, I did saw that. That's the second time somebody mentioned him to me, by the way. Thank you. I'm definitely going to chase that lead. Thank you.
Yeah, he does a lot of stuff with demography and geography and stuff. It's in my exposure, it's not a viewpoint you see a lot when you get into the demographic side of economics.
I have to admit, up to about a year and a half ago or 2 years ago, I think I'm way under, and I have a very Keynesian bent in my education, and I'm in the process of burning it all down and building something new. And one of the things that I would say is definitely part of that model is definitely demographics is destiny. And so I am starting to really agree with that. The driving force of the demography and where people are in their life cycle, I think has there's a lot of intuition behind that. And I definitely didn't get that as an undergrad in economics for sure. And so when we're trying to rebuild, okay, let's say you completely ignore everything you ever learned about econ and wanted to build something completely new. I think that there's a lot to be said for that aspect of it.
So I just went back to look at, oil.
Oh no, that's going to drive me crazy. We had BD and then we lost him.
Yeah, cliffhanger.
Yeah, that's right. We're like, what was he going to say? The one thing I will say too, though, is I wonder, based on Dylan's point about reshoring, maybe long Mexico, think about that as a potential consequence of Mexico being even more viable. Mexico real estate or Mexico industrial might be an interesting. Oh, there he is. He's come back in.
We should just take over Canada and then take over Mexico.
Well, we've already begun our invasion with Dan Friedenberg is literally our plant in Canada, and we are beginning our operation 51st state is well underway.
He's got a long way to go. He's lacking.
Well, it takes time. We're being subversive right now, so it'll take a bit of time, but when it hits, it'll be amazing.
Yeah.
I like that. Dylan's confidence in my plan is like, yeah. BD, we are really excited to hear what you were about to work on for us.
No, I just shared a link on the chat. I don't know if you want to share a screen, but
Yeah,
basically this just shows the oil consumption by barrel by country. And, China is number 2 after the US. And even though they're about like 12 point something million barrels a day, they import about 7 point something. And it's growing.
Yeah, that'd be interesting year over year to see the trend also. That's a great data point.
Mhm.
There's another, if I'm starting all over again, understanding more the dynamics of the energy market, I don't think I got near enough exposure to that aspect of things as an undergrad, and I'm looking forward to building a new model for that.
Yeah, the interesting thing from this chart, when you look at it per capita, we're at 934. So it tells you that we need to really slow down on driving those big suburban SUVs.
Well, BD, if this tells you anything, my next purchase is a Lincoln Navigator, and I'm going to put a Greenpeace sticker on it.
Yeah, like how they have, I don't know where you live, but like in California they have those Save the Earth license plates that you have to pay extra for to get. I saw a guy driving a Hummer H2, and he has Save the Earth. I was like, okay, 6 miles per gallon.
I see where he's going with this. I'm pretty sure he doesn't mean it.
I mean, when you have a country the size of a continent and you want to drive and move things around, I mean, you need a bigger vehicle to store things. It's not like Europe where you can just hop on a flight or mail things back quickly, or your grandparents live an hour and a half and that seems like light years away for them. Like an hour drive, 2 hours round trip is most people's commutes to work every day. I have a friend in Europe, and he said he hadn't seen his parents in years because it's such a far drive, and it was 45 minutes. It's like you could walk that if you want to.
Yeah.
So, I mean, the slowing down on the cars and whatnot, that's definitely not going to happen. I mean, our country is pretty much bigger than 2 continents, Europe and Australia. So,
well, California's 2035. You can't buy a gasoline vehicle.
That's true.
I mean, the California effect is what drove emission standards. It's a big enough market. It moves the rest of the nation, or potentially will change how people approach things, because they don't want to make 2 kinds of cars.
Well, I'm certainly not opposed to the idea. I think in general, it might be a really positive effect generally, even from an energy independent standpoint.
We just need to build a nuclear power plant.
Yes, I'm glad that you guys have agreed with my my nuclear power plan. That makes me beyond thrilled that I've got your support in my upcoming presidential campaign.
The only problem I can see to that is the potential attack exposure it puts us at.
Mm-hmm.
All it takes is one bomb to hit one power plant, and we're in bad news bears territory. But I mean, if you want something sustainable and clean, yeah, you go for nuclear, and then you just take that shit and dump it somewhere up the north parts of Canada.
Well, yeah, that's our main reason for acquiring Canada in our 51st state plan is we need somewhere to take our nuclear waste.
I mean, no one lives above a certain threshold line in Canada anyway, and the ones who do just need to get out anyways.
Well, I mean,
So-
and if polar bears start to glow in the dark, I mean, I think that'd be kind of cool. So,
No, I mean I'd say make it. Have you ever seen images of the seed thing in like Sweden or Iceland, whatever? It's a big underground bunker with every seed of every plant or tree on the on the planet in the event of nuclear, like the planet going to complete waste, so they're able to regrow everything. We just do something like that for nuclear waste. You just make a big thing underground and just dump it on in.
Like a modern day Noah's Ark.
Yeah, just very deep underground in a very big hole.
I think that's a solid plan. I think there was a big debate about Yucca Mountain, Nevada, about that very thing, and they had a big rigmarole about it. I remember something about that. But
No, you just throw it in the super far north parts of Canada.
that's right.
No one lives there anyways.
Well, guys, I do have a call at the top of the hour here. Thank you so much, guys, for hanging out. Next time, I do think I have a great idea. For folks that are new to economics, one of my top recommendations is The Big Short. So I would like to do a economics presentation on what are the economics lessons we can learn from The Big Short, and how does that teach us about modern macroeconomics? And I thought that'd be a fun presentation. And again, if Dylan has anything, I'm sure he'll be cooking something up in the kitchen. So he might take over one of the presentations here, and we'll alternate or get some multiple aspects on things, and we'll try to continue to bring up some good topics.
Yeah, at some point I want to talk about the US's hidden debt and Forex swaps.
Ooh, now that will be juicy. All right, guys, thank you so much for the time. We'll talk to you guys soon.
See y'all later.
All right,
Thanks,
bye-bye.
Dad. Thanks, everyone.